Andrew, this month we've chosen to look at a fund in a bit more detail. It's the Harmony Australian Dollar Growth Fund. To kick us off then, can you just give us an overview of that fund?
Sure. The Harmony Aussie Dollar Growth Fund follows the same model as the 7 other Harmony portfolios that we manage, in that it is a UCITS fund of funds portfolio with a multi-currency profile with a very strong bias towards the Australian dollar, invested in best-of-breed managers across a wide range of different asset classes. Some of the key differentiators that I would note include our rigorous and in-depth manager selection approach. We're very focused on identifying the very best managers across different asset classes, the ones with the greatest long-term outperformance potential, and then we combine them with different investment styles in order to optimize the portfolio and ultimately increase return with reduced risk over the long run. Also, the fund provides exposure to a wide range of more niche asset classes such as convertible bonds or listed infrastructure, and then also the return contribution that we look to generate from our dynamic asset allocation approach, whereby we're very willing and able to vary asset allocation and portfolio positioning significantly, primarily as a result of valuation moves.
Absolutely. So a wide universe of potential asset classes going into these funds, implemented by specialist managers who you will oversee kind of a selection of those. And now typically we tend to talk about kind of strategic asset allocation for the funds. That would be its kind of typical asset blend, is that right? And within that, you typically have 2/3 in Australia and 1/3 invested globally. Is that about right?
Round about that, yeah. So the strategic asset allocation for this portfolio is 65% equity, 10% listed property, 20% in fixed income, and then the balance in cash. At present, we're positioned with a slight overweight versus that strategic asset allocation towards equity.
Yeah.
So we've got around 70% in equity, and then a further 10 in listed property and infrastructure, which will behave like equity in the short run, but should reflect the underlying property and infrastructure fundamentals over the longer term. And then we've got a slight underweight towards fixed income and around 5% or so cash at the moment. You're right, there's around 2/3 typically on the strategic basis invested in the Australian dollar.
Yeah.
At the moment, we've got about 40% or just over 40% in Australian dollar-based investments, assets there, with the balance invested globally, with the second highest concentration being towards Asia ex-Japan there. What we do is we are very careful with managing the currency exposure within the fund. Our intention is for this fund to be a core holding for investors looking for Australian dollar denominated returns.
Yeah.
So we want to minimise the currency risk there. So we'll always have at least 2/3 in the currency, but we can implement that via a currency overlay. So the 60% or so that we have invested overseas, we can hedge some of that back to Australian dollars. The benefit of investing more overseas is you get a broader opportunity set with the opportunity to choose from a much wider range of investments, and for us a much wider range of different managers. And we feel over the long run that will serve to improve the return and reduce the risk profile of the fund.
A broader note then on the managers in this particular portfolio.
Okay, so looking at the underlying manager composition, the fund comprises around about 20 underlying fund holdings. Each one of those, of course, is in itself a diversified portfolio of different investment instruments. And worth highlighting that although 20 may seem like a lot, over 50% of the portfolio is held in the top 5 of those. And even the small positions that we have in the portfolio are very valuable in terms of the diversification that they introduce, be it in terms of manager diversification or asset class or investment style as well. And also worth highlighting that no single holding will be more than 20% of the portfolio at any time. We, as I mentioned before, put a lot of time and effort into our manager research process to make sure we identify the very best managers globally and across each of those different asset classes. So some of the top holdings we have within the fund include, say, the top holding is the Aberdeen Australasian Equity Fund, and then we have others such as the Artisan Global Value Fund, First State Global Infrastructure. On the Australian bond side, we use UBS as the manager there. And as with all the funds that we manage here, we conduct extensive due diligence into the underlying holdings to build confidence that they're the best for that asset class. So that includes numerous meetings with the management team and also plenty of quantitative analysis, etc. We also visit all the managers on site before investing with them. And as you'd expect in this portfolio, some of the managers are Australian based, and for each of those we have visited Australia and met with the managers there and met the broader team, got a better understanding of their process, etc. So that includes Aberdeen, Maple Brown Abbott, and UBS in this case.
How is that translated into performance? Ultimately, the acid test of any investment strategy.
Of course, in 2014, the Harmony Australian Dollar Growth Fund was up 6% in AUD terms, which compares to a 7% gain or thereabouts for the Australian equity market. However, the Harmony Fund achieved it with a much smoother path, with smaller peaks and troughs, and just lower volatility along the way. One of the drivers behind that was the global diversification built into the fund, which was a benefit in a year like last year when the Australian dollar was down 9% or so versus the US dollar. For example, one of our Asian equity holdings, the Prizik Asian Income Fund, was up around 28% when measured in Australian dollar terms. So that was a big benefit. Looking back over the longer term, the fund has achieved around an 11.5% annualized return over the last 3 years in Australian dollar terms, and that's been achieved with volatility of around 6%, which is around half that of the Australian equity market. And another way of looking at that is that the fund has had much smaller drawdowns than the Australian equity market. So the maximum drawdown over that period for the fund was around 6%, whereas the Australian equity market had peak to trough declines of over 10% over that period.
Andrew, thank you very much.
Thank you.